Kenya's annual inflation eased to a two-year low after the currency's world-beating streak helped rein in import prices. For more on this story, joining us now is Bloomberg's Ondiro Oganga. Ondiro, what factors have contributed to the slowdown in consumer prices?
Vonnie, we are seeing several things contributing to this ease, one of them being a steady decline of prices of food, transport, water, electricity and gas prices over the last year from 2023 March to 2024 March. Other factors also include great weather. Kenya is anticipating heavy rainfall, and this should be good for agricultural production and also boost hydropower production, easing prices of food and also electricity moving forward. The government has also set aside money for subsidizing fertilizer and seeds, which again is meant to boost food production. But most importantly, they've also cut gasoline prices by 3.5%, meaning that transport costs have gone down from 10.8% to 9.7%. But earlier on in the intro, you mentioned the Kenyan shilling. It's been steadily gaining against the dollar, and this has eased a lot of prices because Kenya is a heavy importer of both food and non-food items.
Ondiro, talk to us about the significant gains of the shilling as you have been, and you know, what's behind these gains?
The most dramatic gain in East Africa, so to say. We saw the Kenyan shilling take a beating for the last 4 years against the dollar, but in the last month it has appreciated massively against the dollar. If we are to quantify it, 19%, and it went from a low of about 165 Kenyan shillings to the dollar to trading around 130, 132, maximum 135. And this is absolutely great news for Kenya. And some of the reasons behind this gain include, one, the new Eurobond issuance of about $1.5 billion that was used to repurchase the Eurobond that is due in June. So that elevated the fear of a default. Kenya also put out an infrastructure bond that was valued at nearly $500 million. But most importantly, we've also seen that the Central Bank of Kenya has hiked its rate to a total of 250 basis points. So this has helped tighten the conditions in the country. And because of this ease in inflation, we are likely to see that the central bank could be persuaded to hold their rates at about 13% tomorrow when they meet.